Hey guys, this is Rudy for Best Investor coming at you from Palm Beach in Florida. It is Tuesday. It is July the 6th. We saw a little mini correction on the market today, and as you know by now, I measure these in Maseratis. So one Maserati, two Maserati. I haven't looked at the final tally for the day. It wasn't a good day, but it was a day to potentially make some purchases. So I did. I did mention to a couple of people on the channel that I was watching Denison Mines. Today I saw Denison drop below $1.50 on the Canadian market where I have some accounts. And so I snagged myself some Denison mining shares. I'm not suggesting at all that you should buy this. You might want to take a look at it. It is a uranium miner. So it just adds to the little basket of stocks that I already have that are linked to the sort of uranium macro bull thesis, which is a combination of uranium mining, nuclear energy, etc., and some rare earth elements like energy fuels. What we're going to do today is talk a little bit about share buybacks. So yesterday I watched a YouTube video, um, and the guy that I was watching was just talking a whole lot of garbage about the fact that the stock market is going to crash because of share buybacks. Now, of course, the stock market may crash, and share buybacks might even play a part in that, but the stock market is not going to crash because of share buybacks. And the reason why I disagree with what he said, I'm not going to tell you who he is or what he did because I don't want to diss anyone. I mean, the guys are just trying to share information and do good, I guess, in terms of giving people fair warning. But his thesis was basically that stocks are going to crash or the market's going to crash because companies are buying back their shares on margin. In other words, they borrowing money in order to buy back their shares. Um, the concept of buying back your own stock is an interesting sort of executive management decision. Do you buy back stock? Do you declare a special dividend? Do you reinstate regular dividends? There are a couple of things that come into play. But I thought what we could do is spend a few minutes and just talk about share buybacks in general. I'm assuming that everybody knows what dividends are, and of course, whether Occidental wants to reinstate them or not is a separate issue, which I cannot speak to because I'm not on the executive team of Occidental Petroleum. In fact, they don't even pay me to make these marketing videos. But let's talk a little bit about share buybacks in general and sort of see what they are and how they work. So what is it? A publicly traded company, which is also called an issuer, in other words, the issuer of the equity, purchases its own shares in the marketplace. And this is one way for them to return cash to their shareholders. As a general rule, companies do this when they feel their stock is undervalued. Now, just very quickly on that point, if you feel your stock is undervalued, so let's say your stock is trading for $1 and you feel that this is grossly undervalued, buying back your own shares effectively means you're investing in your own company. And because you're buying shares on the open market at $1, in my example, if that stock were to go to $2, $3, $4, $5, $10 in the future, then obviously it will give you a great return on investment. Some executive insiders, managers, and some boards of directors members will say, why are you buying back your own stock? Do you not have any other better plan for investing the money that will give you a greater return? How about if you, for instance, acquire a smaller company that's in the same business that you are, you might end up making an even better return on your investment, and it will be ongoing and continuous. So there are sort of two different schools of thought. On one end, you could say, I have $1 million, my stock is trading at $1, I'm going to buy 1 million shares of my own company. Or you could say, I have $1 million, I'm going to buy a small company, and that small business over the next 10 years or 20 years is going to generate a massive return on investment for me as I help that business to grow or add the assets that I've acquired and integrate them into my own company. The other thing about a buyback that you need to know is that it's also sometimes referred to as a float shrink. Basically, what you're doing is because you're reducing the number of common shares that are outstanding, you've reduced the number of shares in the marketplace. That's why it's also sometimes called a float shrink. What's the impact? So the most significant impact right from the get-go is the impact on earnings per share. What happens is the buyback is reducing the company's outstanding shares. So if you think of it in the case of Occidental Petroleum, they have about 930, 940 million shares outstanding, talking about common. If they buy back 100 million shares, then suddenly there's 800 something million shares outstanding in the marketplace. So that's the most obvious impact. The secondary impact is the impact on earnings per share. The biggest impact, per share measures of profitability and cash flow, such as earnings per share and cash flow per share. I'm going to show you an example in just a minute. If the price earnings ratio, which is the multiple at which the stock trades, is unchanged, then the buyback should eventually result in a higher share price. So on a previous video, I said, here are 10 things that Occidental might do to increase their share price. So this is effectively an 11th one. They could do a stock buyback. So here's an example. This hypothetical company has 100 million shares outstanding on Jan 1. I actually mean at the start of the fiscal year, whatever date that is, but let's just assume it's January 1 for the sake of my example. 100 million shares outstanding. The stock is trading at $10. Therefore, the market cap of the company is 1 billion. What is the market cap? It's the number of shares outstanding multiplied by the stock price. So 100 million times 10 is $1 billion. The company, let's assume, is generating a net income of $50 million per year, which would be earnings per share, so 50 million, 100 million shares, of 50 cents per share. Therefore, its PE, or its price earnings multiple, which is the price of the stock, divided by its earnings, is 20 times. So it has a forward PE multiple of 20 times. Effectively, and I might be obviously preaching to the choir here, but these are what these things mean. So I've just explained market cap in case you didn't know, and then PE, how that is arrived at. If you're not sure, you can pause this video and then you can kind of take a look at it. It will probably be clear as mud for a second or so, but after that, it will be really easy to understand. Now, let's assume the company has $100 million of excess cash at the start of the year. So I got $100 million of cash awaiting investment. What can I do with this cash? Well, I can employ more people. I can buy more plant and machinery. I can buy my own stock. I can buy another company. I have $100 million that I want to invest. In other words, I don't want to spend it. I'm going to deploy a 12-month share buyback program. So at the end of the year, because I started off with 100 million shares, at the end of the year, I'm going to have 90 million shares outstanding. And for the sake of my example, I'm just going to assume that throughout the year, we're purchasing these shares back at the market price of around $10 each, just to make it easy math. So let's assume I have $50 million in fiscal year earnings. So at the top, I said net income, $50 million is EPS of 50 cents per share. Now, if I continue to generate $50 million in net earnings or net income, then my EPS will automatically jump from 50 cents to 56 cents because it's 50 million divided by now 90 million shares instead of 100 million shares. And if the stock was trading at a PE multiple of 20 times, the share price would now be $11.20. In other words, I get a 12% stock appreciation because of the share buyback, the earnings per share increase, plus the reduction in the outstanding shares nets me a 12% stock appreciation, in theory anyway, right? What's the impact on the financial statement? So the share buyback does have an effect on the company's income statement because it's reducing the outstanding shares. But how? Buybacks do not impact the income statement line items. It'll impact the bottom line. So the earnings per share figure beneath the net income will show a huge uptick as a result of this, the fact that there are less shares outstanding in the marketplace. How about the balance sheets? So the balance sheet, for the people who've been following me, I talk about the balance sheet quite a bit, right? You have assets on one side of the equation, and the other side of the equation is liabilities plus owner's equity. If you have no liabilities, in other words, if your liabilities are zero, then your assets are equal to your owner's equity, which means that your $100 million company is worth $100 million in owner's equity because you have no liabilities. What's happening on the balance sheet is that the buybacks reduce the company's cash holdings. So on one side of the ledger, your assets are being reduced. Now you have to reduce something else. You can't reduce liabilities because you've just used the money to buy back your own stock. So what you're doing is you're actually reducing shareholders' equity, which is a liability, by that same amount. Why is it a liability? Because the shareholders' equity is owed by the company to the shareholders, right? So assets equals liabilities plus liabilities. One of them is cash liabilities, long-term debt, and the other liabilities to the shareholders of the company, because the company owes money to the shareholders who put money into the company. Other performance metrics such as your return on assets and your return on equity will typically improve as well after a buyback. The previous buyback that Occidental had was in 2014, so now almost 7 years ago. They bought back 60 million shares. How did they fund it? They funded it from available cash from operations, excess cash on hand, and proceeds from asset sales. So not dramatically different to the situation that they're in today, except going back to 2014, Occidental had a lot more cash and a lot less debt. And they said, hey, you know what? Our shares are cheap. Let's buy ourselves back some of the shares. What does it look like on the actual balance sheet? So this blue column over here is the last quarter, March 31st, and the one that's kind of obscured behind my picture was fiscal year in December 2020. Right here at the lower part of the screen, if you look at the stockholders' equity, you'll see an entry on the balance sheet that says treasury stock, 149 million shares at March 31, 2021, and 149, slight difference, at December 31, 2020. So when people talk about treasury stock or treasury shares, they are really talking about shares that have been bought back by the company, which is now reducing stockholders' equity because there are less shares available in the marketplace. They have to record it, and because they use cash to buy it, the cash on the asset side of the ledger of the balance sheet has been reduced. So what you do is you reduce it from a book entry point of view on the stockholders' equity side, and it sits there on their balance sheet. So this is not current as of today, but this is current as of March 31, 2021, which is the last quarter that they reported. So if you look at a balance sheet and you see treasury stock, in this case, 149 million shares, now you know what it is and where it comes from. I went to a website called stocknews.com. It's actually kind of cool. It's the first time I went there. I'm not promoting it or suggesting that you may want to spend time looking at it, but I went to stocknews.com and searched for Oxy, and interesting stuff. I'm just going to sort of start wrapping it up here. Oxy went public more than 35 years ago, making it older than almost 93% of the listed US stocks or issuers that Stock News is tracking, and they track almost all US stocks. So Oxy has been around for a long, long time. Oxy's sales and general administrative expenses compared to its total operating expense, only 3.6% of US stocks have a lower ratio. So Oxy is very efficient when it comes to managing its sales and general administrative expenses compared to its total operating expenses. 12-month growth in earnings before interest and taxes. Oxy is reporting a growth rate of 749%, which is higher than 97% of US stocks. Stocks with similar financial metrics, market cap, and price volatility to Occidental Petroleum are, here's where it gets interesting, DD, ORAN, Eric, LH, and ET. Well, when I saw that line, it's like, this is interesting to me because I have now built up a huge position in ET. But what are the other four? I know the first one, DD, but what are the other four? So I did a quick chart comparison here. DD, of course, is DuPont, the chemical firm, a diversified chemical firm. ORAN is Orange, ADR. So I think it's a UK company as a cell phone provider, wireless. LH, Laboratory Corp of America Holdings. At the bottom here it says medical dental suppliers, and Eric, I know Ericsson mobile phones from before. Also ADR, wireless equipment. So the two companies that are similar here, wireless non-US wireless equipment, that they are saying these companies are similar to Occidental in terms of its financial metrics and fundamentals. And you will know by now that I am a fundamentalist. So these are things I like to look at. Energy transfer. This is a really interesting little pickup here for me because they actually selected 5 companies that are almost as undervalued and potentially as good as Occidental, and one of them is energy transfer. So I might be tempted to hold on to energy transfer for quite some time. The other 4 are less interesting to me because remember, I'm Mr. Oxy or Mr. Fossil or Mr. Fossil Fuel or one of those. So I'm particularly interested in energy. But guys, on that note, I'm going to kind of wrap it up there. And I hope this helps you just a little. I did, before I posted this video, check into the YouTube Studio website quickly because as I usually do at least once a day, I see there's a lot of comments from you, and quite a number that I haven't responded to yet. So what I'm going to do next after this is post the video, and then I will spend a few minutes to review some of your comments and see if I can answer some of your questions. The good news is, if I can't answer your questions, it doesn't matter, because there are a lot of smart people in our community of investors, especially when it comes to matters of energy and fossil fuels and such related topics. So guys, on that note, this is Mr. Oxy signing off, saying thanks for watching. Let me know in the comments what you think about share buybacks. Should Occidental do this or not? You tell me. Till later. Bye-bye.